requesting that we undertake the assessment on household indebtedness and financial consumer protection, which I think the request itself shows the real interest and strong concern that the authorities have in Chile in relation to these issues. As has already been mentioned, my name is Gian Boeddu, and I'm a senior financial sector specialist in the World Bank's Financial Inclusion Consumer Protection team. And I undertook this assessment together with another colleague in the team, Evaluación. Next slide, please. So as, sorry, Claudia, just before previous slide. No, that's it. Thank you. No, the one with the technical note. Thanks. Yeah. So as has already been mentioned, the World Bank and the International Monetary Fund have undertaken a wide-ranging assessment of Chile's financial sector, and it covered quite a few topics, and household indebtedness and financial consumer protection being one of them. The recommendations and findings on this topic are set out in a technical note, which probably a lot of you have read already, but which I have noted on the slide so that it's accessible and is publicly available. And the assessment was completed at the end of 2021, and as we've already heard, there have already been further reforms and initiatives being progressed, and I'm sure we'll hear about these a bit more in the panel session that follows. So in our assessment, we looked at a wide range of information that was provided to us by the authorities and also through our own research. But importantly, we also spoke to a variety of stakeholders, including the various regulators and authorities, credit providers, other industry participants and commentators. And I just want to reiterate that my colleague and I really appreciated the engagement that we had from everyone that participated in our meeting. Next slide, please, Claudia. Thank you. So in this presentation, I'm going to talk briefly about the focus of our assessment and the context in which we undertook it. And I'm sure some of the things that I'm going to say are probably familiar to you and have already been mentioned by the chairperson. And then for the main part of the presentation, key findings and recommendations from the assessment on indebtedness and financial consumer protection. Now, in the time available, it's not really realistic that I cover all the detail in the technical notes, so I encourage you to read it. But what I've done is I've grouped the findings and recommendations that I'll summarize in three categories. One is around credit affordability and suitability, and also debt collection, which was really the core focus. Then I'll talk a little bit about practices in the market around the sale of credit and the marketing of credit. And also in relation to credit protection insurance, also called payment protection insurance. And then finally, I'll make a few observations that we made in our note in relation to the regulatory and supervisory framework for consumer credit in Chile. And then we'll have a little bit of time for questions, of course. Next slide. Next one. Thank you. So starting with the context, as is obvious from the title, the focus on household indebtedness was from a financial consumer perspective. But why I'm emphasizing this is because when you focus on over-indebtedness issues from a consumer protection perspective, what we were looking at was any issues relating to credit, to the provision of credit and related practices that could potentially affect consumers negatively. And particularly more vulnerable consumers, even if the issues are not necessarily a concern from a financial stability perspective, although some of the issues obviously have a concern from both perspectives. And what I really mean by that is sometimes you can have consumer protection issues where you might have quite a large number of consumers affected, but it might not rise to the level that it affects stability, or the numbers involved, the amounts involved while they might be significant for individual consumers, they might not necessarily be significant from a system perspective, but they certainly still deserve focus from a policy perspective. Now, as with, I'm sure, almost everything else we'll be talking about in this conference and everyone is dealing with, the issues we looked at were impacted by the COVID-19 pandemic, and the chairperson has already mentioned this. This included both the economic implications of the pandemic, and the measures that were instituted by the authorities to address it. In fact, we scoped the assessment before the pandemic began, and then had to change some of our focuses as a result. The CMF chairperson has already highlighted some of the things that I was going to mention, which are around the fact that indicators to do with over-indebtedness in Chile were quite high before the pandemic began. So looking at things like the financial burden on individual consumers, and particularly consumers on at lower levels of income, it was found that, for example, Chile had higher levels than some other countries with similar development indicators in a sample that was looked at before the pandemic. And of course, it might be an obvious point to make, but particularly when you are thinking about consumers with lower incomes, the percentage amount that's taken up in terms of financial burden. And what I mean by that is the amount of your income that is used to make monthly repayments. Any shift in that percentage can have a huge impact, given that the amount in real dollars that's available to them is already very low to pay other expenses. And during the pandemic, as we already heard, it was both a reduction in the income for households, particularly lower income households, that they could use to make repayments, and they were already flagging that they were struggling. And then we saw some measures that sought to address some of these issues, at least temporarily. So both industry and the authorities instituted debt repayment moratoria, social transfers to assist with income gaps, and also things like allowing consumers to access their pensions to cover income deficiencies. But what we saw, for example, in our discussions was that quite a significant portion of these pension withdrawals went to paying down debt. And what that means potentially is that some of the systemic or long-term issues around indebtedness that you would be concerned from a consumer protection perspective might have been temporarily masked or hidden by some of the measures, which is not to say the measures are not appropriate for other reasons, but it's just worth thinking about when looking at these indicators. And as we've just heard, and it's actually a statistic that I had not heard, the latest statistic is that I think 20% of borrowers are using more than 50% of their income to make repayments, which is very significant from a consumer protection perspective. So in our assessment, what we were looking at were both obviously these indebtedness indicators or issues of consumers, industry practices that could be contributing to consumer over-indebtedness and hardship, and then regulatory gaps or supervisory gaps that also existed that could be contributing to these issues. And I should acknowledge, and we've already heard, that a lot of consumer protection reforms were already being made before our assessment, in fact, during our assessment, and I know that they are continuing. And so as we described in the note, for example, there were a lot of reforms around consumer disclosure, the conduct of lenders, and also an expansion of resources and powers for supervisory authorities. And so the recommendations that we've made are really intended to build on that. They're intended to strengthen further the consumer protection framework and also the improvement of the practices of the industry around these issues. And just as a final observation before we start talking about the findings and recommendations of our assessment, I'm of course aware that the market in Chile for credit has quite a wide range of providers, from banks to credit unions, credit card providers, and so on. But that, at least at the time of the assessment, for example, lower income consumers were being primarily served by the non-bank sector. But I want to emphasize that a lot of recommendations are intended to apply across the board, and they're not just for lower income consumers, for a couple of important reasons. One is to ensure that consumers across the board, regardless of provider type, receive the benefit of the improvements that we would recommend, and also to ensure that any reforms are even across the industry. So you don't have an uneven treatment of providers or even of consumers, depending which provider they deal with. So now turning to the main part of my presentation. So next slide and next one again. Thank you. Starting with what I said is was the core of our focus, which is around credit affordability and suitability issues. Ensuring that credit providers provide affordable credit has been a key concern from a financial consumer protection perspective for a long time, but the focus has obviously increased given the financial crisis from a decade ago and now the pandemic. And as I said already, often the focus on affordability from a consumer protection perspective and a stability perspective overlaps, but sometimes there can be some differences. So while some of the indicators from an indebtedness perspective in Chile suggest that part of the population may be acquiring unaffordable consumer credit, that would be a concern for consumer protection, even if it wasn't yet for stability. And until last year, we found there was a lack of obligations in terms of consumer protection for all credit providers in Chile to conduct individual affordability assessments before providing credit. And internationally, there has been really a strengthening of requirements for credit providers to ensure that they don't offer or they don't approve loans to a consumer if they haven't checked that the consumer is able to repay the debt without financial hardship, looking at the financial circumstances and their existing commitment. And as I said, there is some difference sometimes between how this obligation is placed from a consumer protection perspective or a prudential perspective, as well as the fact that, of course, some providers are not prudentially regulated. And for example, FincoNet, which is the Association of Financial Consumer Protection Regulators for banking products, has noted that sometimes you could have a situation where consumer protection obligations on affordability mean that a provider should decline making a loan, even if that loan might be acceptable from a credit risk perspective, from a prudential perspective. So we did see that a new obligation has been introduced at the end of 2021, which is a general obligation for all credit providers to assess the solvency of the consumer in terms of their ability to repay the particular loan on the basis of sufficient information. And we think this is a good thing, and it's also good that it's applying to credit providers across the board. But as we said in our assessment, it's important that the requirements go beyond that, because this is a very general obligation. And the legislation contemplates that regulations may be made under it, and I'd be keen to hear in the panel discussion, for example, progress on that. But our recommendation is really about ensuring that those regulations are sufficiently specific and sufficiently clear regarding what expectations there are for credit providers around the information that should be collected and verified and then used for the assessment. And now this issue about making sure these obligations are sufficiently clear and specific while also remaining balanced is not unique to Chile. So for example, the European Union has a consumer credit directive, and that directive had similar general requirements, or still has, because it's still in effect. And the European Union has identified that the existing language is probably too general, hasn't been sufficient to provide adequate protection for consumers. And there have been various reforms in Europe, including more detailed guidance from the European Banking Authority around affordability assessment, and now reforms to the Consumer Credit Directive itself, amending the language that are intended to improve this. Closely connected to standards or requirements for lending assessment is, of course, the kind of information that is available to credit providers to use to make these assessments. And the CMS chairperson has already highlighted this. So if you have gaps in the types of data that are available, or you have gaps in which credit providers can access that data, that obviously can have significant consumer protection implications because it can undermine the ability of credit providers to make an adequate credit assessment. Now, we could have an entire discussion on the credit information system in Chile, and I don't propose to do that. But just to highlight a few things. One is that this is a topic that in the assessment that the World Bank did and the IMF did has been covered in several topics. It's not just a consumer protection issue, but we also discussed it in our competition in the financial sector component of the assessment and in our digital financial inclusion component. And all of these have their own technical notes that are publicly available. For present purposes, a few examples of things and gaps that were a concern from a consumer protection perspective. So for example, we know that CMS administers quite a substantial database around credit information, but this has not been accessible to all credit providers. I know that the access has been expanded, but if you're going to have standards on all credit providers around credit affordability assessment, then all credit providers would need access to this kind of information. Also, the database has not had historical information about previous loans, repayment history, and defaults. And so our understanding from our assessment is that lenders have built their own historical database using snapshots from the registry. But again, this is not something that's realistic or feasible for lenders. Other issues that we flagged, for example, are around whether new kinds of information should become accessible, particularly to help assess, for example, credit being made to people that don't have a credit footprint, that already have other borrowing. So thinking about things like information in relation to utilities and telecommunications, which I know at the moment is restricted under the privacy legislation in Chile. And then also of concern in our assessment were proposals to delete some credit default information. And while we understood what the intention might have been from other perspectives, from a credit information perspective and consumer protection perspective, deleting the history of some consumers was highlighted by quite a few lenders in our assessment as something that really creates a gap in terms of how they can assess these borrowers going forward. And so our recommendations around that are both bridging these data gaps, but also the access gap. Now, even with the introduction of stronger affordability assessment requirements and improvement of credit information, we also think that there is room for improvement in Chile regulations around credit suitability and appropriateness more generally. And I'll explain what I mean by that. Firstly, the international good practice has been developing around not only expecting credit providers to make sure that credit is affordable, which is an important but relatively narrow concept, but also ensuring that credit is appropriate for a consumer's needs and objectives. And at the time of the assessment, we saw that there was a new obligation being proposed in Chile requiring not just credit providers, but financial services providers generally to ensure that they don't offer products to consumers unless those products are consistent with their needs and expectations. Again, this was a good idea, we thought. It will be a good reform, but we had a couple observations on this. One is that, as we understood it at the time, the proposal would only apply to institutions that are supervised by CMS, so it would not apply to all credit providers, which potentially creates one of the gaps I talked about earlier around ensuring even treatment of industry, but also of consumers, regardless of which kind of provider they deal with. And then the other observation that we made was around the fact that, similarly to the affordability requirements, while a general obligation is good, it really needs to be supported by regulations or guidance that provides clarity around what are the expectations when these kinds of suitability assessments are undertaken. And in addition to suitability assessments, what we've been seeing around the world is jurisdictions introducing what are called product design and distribution requirements. So the idea here is that when, and I'll talk about credit providers, but the development applies to other financial service providers too. But the idea is when a credit provider is developing a new type of loan, a new credit product, or they are modifying the features of an existing product, that they should be thinking about who is the target market for that product, and are the features of the product and the pricing structure and the transparency appropriate for that target market. And so one of our suggestions is that the authorities in Chile think about introducing these kinds of requirements, which we did not see, at least at the time of the assessment, were being proposed. I should note, our recommendations talk about making sure these requirements take a proportionate and scalable approach. And what we mean by that is that a requirement around product governance and product design needs to be flexible. It needs to take into account the nature, scale, and complexity of the business of the provider, and also the complexity and risk of the product. So there wouldn't be the same level of expectation around determining the target market or product testing for all products. It would vary. So that would be an important component. And then finally, turning to debt collection. Now, it was not surprising to us, and I'm sure it's not surprising to you listening, that debt collection practices in Chile were consistently identified in our interviews as a major cause for concern. They are also a major driver, a major cause of complaints in Chile. And one would hope that strengthening affordability assessment requirements, so improving the way that credit assessments are done, might reduce the number of consumers that default and therefore that go through debt collection. But the reality is that that is not going to remove this issue altogether. We were made aware that the regulations around debt collection were being strengthened recently. And for example, we saw that there have been improvements around the rules to do with how many calls can be made by debt collectors, the times at which these calls can be made. So our recommendation, debt collection, at least in the near term, is given that have been these improvements in the regulation, we really think there should be a strong focus on implementation. And what we mean by that is both around guidance for industry on what these new expectations are, but also around supervision and enforcement. Now, this is not only relevant to debt collection, it's relevant to all the recommendations, but having regulations is good, but ensuring in a timely manner that industry is changing their processes, improving their practices to take into account these rules in a timely way is very important to ensure that they have a positive impact in the market. So that is why in our assessment at this stage, we did not recommend any additional regulatory amendments, but more an immediate focus on these issues based on these new requirements. So that was everything that I was going to summarize in relation to these issues. Obviously, there's a lot more covered in our assessment and in our note. So if we could go to the next slide, please. Thank you. Another issue that we really focused on was around industry practices to do with the sale of credit and the marketing of credit, and also in relation to insurance that is sold in connection with credit. So we saw from our interviews and our research that credit providers in Chile have been placing increasing emphasis on things like pre-approved credit offers and more aggressive or more intensive credit sales and marketing, including through digital channels. And this was not surprising to us, and it's not to you. This is a development that we are seeing internationally. So, for example, in our discussions, multiple banks were indicating that their pre-approved offers have been growing, and particularly the marketing of these offers through digital channels, including online, mobile apps, and SMSs. While this is not surprising from a commercial perspective, a lot of consumers are moving onto digital platforms. It is true, and it's been seen internationally, that these kinds of approaches and these use of channels can increase the risk of inappropriate credit offers being made to consumers. And even more so if the credit assessments are not adequate, and hopefully the credit assessment standards will grow, and that will also assist in these offers improving. But even leaving aside the credit assessments, the greater speed at which credit can be contracted through digital channels, and also that can be approved, can have various effects on consumers. So for example, the behavioral biases can be exploited, so they can be encouraged to make more impulsive decisions. It's not just to take up loans that they don't need, for example, but also to take up larger loans that they need or that they were thinking about in the first place, and also having less time or less space to contemplate or consider the taking up of credit. And the reality is that lower capacity consumers, and that's not just lower income, but just lower capacity in terms of education and so on, means that they have less ability to make appropriate choices and decisions. And things like disclosure, for example, would not necessarily be able to bridge the gap. So providing them with more disclosure or even better disclosure would not by itself necessarily be able to bridge the gap where you're having them make these decisions more quickly, more impulsively, or with greater encouragement. We also saw in our assessment that some of the existing regulation around unsolicited offers did not seem to have be keeping pace, to be keeping up with these digital market developments. So for example, we're aware that telephone numbers and email addresses can be placed on a do not disturb register that's administered by CERNAC, where consumers can indicate they don't want to hear from commercial entities generally, although it's not specific to financial services. But it wasn't clear to us that these apply to all kinds of channels, so that you could say, I don't want to hear from you through social media or through other digital channels, for example. We also saw that there is a cooling off period of 10 days to terminate a contract. But again, this seemed to apply to offers being made in meetings or in calls. So we queried how this is adapting when a lot of this is happening in a more digital environment. Our recommendations around this are for the authorities to consider more specific or targeted restrictions on unsolicited credit marketing, including via digital channels, or looking at adjusting existing restrictions if that is considered more appropriate. And these will be complementary to improvements around strengthening of affordability and suitability of products that are offered through all channels, including digital channels. So some examples that you see overseas of some of these kinds of restrictions include, for example, that consumers can specifically request not to receive solicited offers in relation to credit or financial products, or sometimes that consumers be actually required to opt in rather than opt out, given again that they might not be aware of the ability to opt out, or they might not do that so readily. Turning to some issues that have to do not so much with digital channels, but with face-to-face or direct contact in terms of the sales of credit, which of course is still prevalent. I'm not suggesting that the sale and marketing of credit it has replaced the sale through branches or through calls. Most of the credit providers that we interviewed confirmed to us that there was a strong focus on incentivizing their staff to sell credit by linking the financial rewards, so the remuneration, the amount they would earn, to achieving sales volumes and sales targets. This was confirmed by the full range of credit providers, whether it's credit card issuers, banks, credit unions, auto finance. And we heard that these kinds of incentives could be quite significant. In some instances, they could make up the majority of the remuneration that staff were receiving. We also didn't see much in the way of a historical assessment, for example, of whether the credit that staff were selling was of an appropriate quality. So looking back and not just looking at sales volumes, but the kinds of loans, the quality of loans that we're making. We didn't see a lot of that happening. Again, having incentives for staff that are based on sales is not unusual internationally, and it can make sense commercially. But it is important to note that it can lead to concerning conflicts of interest. And this has been seen repeatedly around the world. So, for example, the staff of a credit provider that are heavily incentivized on this basis, without even intending to do anything wrong, may be framing information or framing discussions that they have with a consumer about credit products is biased in a way that leads the consumers towards options or decisions that will generate the most remuneration for the staff members, but are not necessarily the best outcome for the consumer. The reality also is that sometimes they may lead staff to engage in more aggressive and higher pressure sales tactics to maximize intake. And the reality is, and it's been found in other countries, that consumers, particularly less experienced consumers, can place a lot of trust on staff and may not necessarily appreciate that there are these incentives, or that staff might not be providing advice that is fully in the consumer's interest. And so these conflicts of interest can arise, which by conflicts of interest, what I mean is that the interests of the staff member or of their employer are not necessarily fully consistent or aligned with those of the consumers. And these incentives and the issues that they can give rise to are not necessarily limited to sales staff. If you have back office staff or approval staff that have any of these kinds of incentives, for example, when they're designing products or when they're approving products, you could have some of these issues. And now we saw that in Chile there are regulatory measures, there are regulatory requirements around mitigating conflicts of interest, but that they focus more on other products. We saw them more in relation, for example, to insurance and securities, and we didn't see similar requirements applying to all credit providers across the board. At the time, the CMS had issued a policy paper that was highlighting some consumer protection issues that he would expect the institutions that it supervises to focus on from a market conduct perspective, and mitigating conflicts of interest was one of these. And again, we would say that's a good thing, but it would only apply to institutions that are covered by CMS. And as we all know, and as I said before, that would not cover all credit providers. So based on some of these findings, the kinds of recommendations that we've made are to introduce or to ensure that there are conflicts of interest requirements for credit providers generally. And these would really place an expectation on credit providers to have measures to ensure that if there are conflicts between their staff or themselves and consumers that might be taking up credit, that these are mitigated appropriately. And then having clearer obligations around remuneration structures and incentives for staff. So that it's not necessarily just about the sales volumes, but it would mean taking into account things like the performance of the loans that the staff might be selling. So do they turn out to be affordable? Compliance with consumer protection requirements when staff are dealing with consumers, and having a look at, for example, complaints and compliance reviews and how they affect the loans that particular staff have made. And those are just a few examples of the kinds of things that would have to be taken into account for remuneration structures. So turning now to a credit or payment protection insurance. And just to clarify, what we mean by that is particularly insurance that's often bundled with loans, and that covers the ability of the borrower to make repayments in situations such as when they lose their employment, when they're ill, suffer from a disability or death. So that's what we mean by credit protection insurance or payment protection insurance. In our discussions and our interviews, a range of credit providers confirmed that they were selling credit protection insurance to a large portion of their credit portfolio. So, for example, a number of banks estimated for us that the credit protection insurance had been bundled with up to 80% to 85% of their consumer loans, which is a very high proportion. And also that there are various incentives, not only for staff, but also for consumers to encourage the take-up of credit protection insurance. Now, I just want to make clear that bundling of credit protection insurance of itself is not necessarily always an unfair practice. But the reality is, and based on international experience, is that you can have consumer detriment if, for example, consumers are purchasing insurance that they don't necessarily want or need, or incurring additional costs for insurance that they don't necessarily understand. Or, for example, this insurance may be contractually optional, and that's our understanding in Chile, but the optional nature might not be entirely clear to the consumer, or whether the policy represents good value in their particular circumstances might not be necessarily clear. Also, consumers may be affected by the sales techniques that I was mentioning earlier. So if you have staff that are incentivized to sell it, then they can sway consumers to make particular choices, relying on what we call, for example, behavioral nudges, to take up the insurance where that might not necessarily have been the consumer's choice in the first place. And the reality, the commercial reality is that the sale of credit protection insurance can be very lucrative for credit providers. A significant portion of the premiums of such insurance go to commissions for lenders, and this is why there is a significant incentive to increase sales. And we have seen, and I'm sure you are aware of this, but we have seen internationally that inappropriate or excessive sale of credit protection insurance has caused major issues in a lot of markets. And so in our assessment, our concern would be to make sure that these issues are avoided or are mitigated in Chile, so that there isn't a repeat of these issues, which a major cause of consumer complaints, and not just credit protection insurance. And also there have been, for example, settlements with insurance companies around this, although it was not just in relation to credit protection insurance. We're aware that the rules for the sale of insurance were recently improved or strengthened in Chile. So now there is a requirement that if you sell insurance with credit, the consumer must ratify that sale within 30 days. A couple of comments that we made on this in our assessment was, one, it was not clear to us that would be sufficient to give a consumer sufficient room to contemplate the separate acquisition of the insurance, because the current obligation, for example, didn't make clear that the ratification couldn't happen close to the sale of the credit. So you could have the momentum of the sale of the credit still mean that the consumer gives the ratification without sufficient contemplation. And then the other issue or concern that we had was our understanding is that payment protection insurance is not covered by this ratification requirement. So the consumers would not receive the benefit in relation to that particular product. Given these issues, what we've recommended is removing the exclusion of payment protection insurance, but leaving that aside, strengthening the measures around the sale, the bundle sale, or the sale of insurance with credit. And to give you some examples of what countries have done around the world on that, is not just requiring ratification, but, for example, requiring the deferral of payment protection insurance sales from the credit sale, so that the actual sale needs to happen at a later time. So there might be a few days later, after the loan has been sold, that the insurance is offered separately. To separate, for example, this concept of the insurance not being required to be acquired with the credit, being optional, and so on. We've also recommended more generally that the authorities think about having a comprehensive review, a thematic review on insurance, because on credit protection insurance sales, because from some of our interviews, it wasn't clear to us not just whether there was sufficient emphasis yet on the appropriate sale and sales techniques, but also on the suitability of the particular product. So were they providing value for money in the circumstances of borrowers? And to give you an example, that's thinking about, for the particular borrower circumstances, does the coverage of the policy mean that they're going to have coverage for a lot of issues or only very few issues? Are the exclusions something that means that the coverage is very narrow? Do they appreciate that there are time limits and so on? So I think we'll turn to the final slide, please, Claudia. Very briefly, as I'm conscious that I'm running short of time, I just want to make a couple of remarks around the regulatory framework for consumer credit in Chile, and again, conscious that there have been very recent reforms, and the reforms are continuing. As I've already mentioned, some of the regulations apply to credit providers that are regulated by CMS. As we understand, CMS is responsible for authorizing a range of institutions that can provide credit. And in any situation where CMS authorizes them, it then shares information about them with CERNAC, who is responsible for enforcing the protection of consumer rights law. But credit providers that are not authorized by CMS are not subject to any kind of registration requirement or authorization requirement. And the sense that we had is that this means that the authorities might not have the benefit of as full a view of the market as would be the case if there was, at the very least, a requirement for all credit providers to register, so that there was a snapshot of credit providers operating in the market. We've also suggested thinking about a regime that goes beyond just pure registration and will be some kind of authorization or licensing, because that is being used in other countries as a way to have a little bit of gatekeeping or vetting of the quality of credit providers that are operating in the market. And that is not suggesting the same level of authorization or vetting that you would do for prudentially regulated entities necessarily, but it will be some level of checking before an entity can undertake the provision of consumer credit in the market. We also have the sense that you have sectoral laws that are enforced by CMS that apply to some credit providers, and then there is also the general consumer protection law with a lot of consumer protection requirements for credit. And so potentially what you might have is an overlap in the supervision and the enforcement of different authorities in substance, even if the laws are separate, because some of the issues for consumers might actually be covered by multiple laws. And so we've noted that coordination between the authorities is important, but that maybe thought should be given to whether the system as it operates at the moment is going to be able to deal with the expansion of the market, the developments in the market, and also these overlaps. So we've recommended that the authorities think about a review of the framework, of the arrangements, of the process, of the resourcing for financial consumer protection supervision, because as I've said, there is an expansion of the market, and I'm sure it will continue to expand around new kinds of entrants, new kinds of entities. And the question is really, will the current arrangements be sufficient and be effective in the future and not just in the present? And one other observation, and I want to emphasize, this is not just an issue in Chile, it's something that regulators are grappling with around the world, is that we had the sense that a lot of the supervision and the enforcement had needed to be reactive. So it needed to react to remediate consumer harms that have been having a significant impact. And so we've made some suggestions around how to move to perhaps a more proactive approach to the supervision that looks at early detection or prevention. And again, this is an issue that we work with regulators around the world, which is to try and in a way to preempt some of the issues that could arise in the market, both looking within the market and international. So that was my summary around the assessment, and I appreciate that I have given you a lot of information in 45 minutes. And I'll stop there, and I'm very, very happy to take questions, and I'm also looking forward to the panel discussion. And again, my thanks to CMF, the authorities and stakeholders for the interest in this topic. Thank you.
We are very grateful that you shared your time and all the analysis and the extensive meetings that we had during the FSAP. And we have surely a lot of work forward implementing all these recommendations. Unfortunately, we ran out of time for having Q&A, but I'm pretty sure that we'll be talking in the future because, as I mentioned before, we have a lot to do implementing all the recommendations in this topic and all the others that we'll be reviewing in the following sessions of this conference. So once again, Gian, thank you very much for your time today and all this information that you share with us.
Thank you, and apologies for running over time.
It's all right. There is a lot of information, and we have a lot to learn, and we have to do a lot to implement as well. Thank you.